Hello, here now I'm going to deliver the lecture for the module number 4, that is fund flow statements. Which are the topics to be covered under the fund flow statement: meaning, definitions, classifications of essential sources and applications of fund flow statements, significance of fund flow statements, limitations of fund flow statements, effects of fund flow statements, the part of the meaning of fund, then the statements of changes in working capital, adjustments effects of a fund flow statements, determinations of a fund flow statement, differences between the fund flow statements and financial statement, as well as the fund flow statements and profit and loss account. Let's move to the first point, the part of introduction of a fund flow statement. Here, the fund flow statement is all about the changes of fund into inflow and outflow of the business. That means funds comes in the business and goes out of the business. It is beyond disputes that developing a certain financial statements helps evaluate past and present performance of a business concern very effectively. That means the financial statement analysis of the past years and the present balance sheets, it always gives effective outcomes of the particular concern. So the revenue statements and position statements are as well familiar as important accounting statements of a business organization. So the two important statements are there which are very much important for the business organization. As you know, the balance sheet shows the financial positions of a particular undertaking that represents assets and liabilities on a particular date. So balance sheet revaluations is the part of assets and liabilities, while the profit and loss account shows the informations of revenue positions on at the end of the particular year. So it means the whole year whatever the situations were occurred, that will be reflected through the profit and loss accounts. It reveals the financial positions of the business. These are very important functions. There are certain other affairs considered within the balance sheet at the beginning and at the end of the accounting period, which are not disclosed by any of these two statements. It means there are certain imbalance, there are certain clauses where you can determine from the beginning of the year and compare with the end of the year. That means there are some changes which occurred during the year that may not be reflected from any of these two statements. In view of accepted importance of capital inflow and outflow, which often absorb large amounts of money, should be reported to the stakeholders. That means the inflow and outflow has been done, but this inflow and outflow has actually arrived in during the year by any of the stakeholders. This actually reflects through the fund flow statements. That means from the fund flow statement only you would be identified that the amount of funds comes in the business and goes out from the business from particular different stakeholders, and who withdrawn the fund from the business would be identified through the certain analytical tools that the fund flow statement would provide this type of concern. Balance sheet does not show the movement of funds. It reflects only what was the position at the end of the year, whether how much amount of equity capital, how much amount of the preferential capital, debentures, etc. and etc. So it reflects only the closing balance of the respective heads. The study and managing these funds or this fund flow process is the main objective that the financial management to measure the soundness and the solvency of the business. That means it reflects the how much amount of strength and the solvency positions of the company. It reflects through this analysis of financial statement, along with the informations about the assets and liability as well as the profit or losses. It is equally important to know that the funds become available during the accounting period and how such funds were applied. That means how much fund has been actually kept into the business, how much fund is retained in the firm in the business, and how the fund has been utilized during the year would be analyzed and find out the outcomes from the analysis of financial statement, and that is possible through the analysis of fund flow statement. Therefore, an additional statement should be prepared, and that additional statement shows changes in assets, liabilities, owner's capital, borrowed capital, changes in working capital, or any part of non-cash items are also reflected through this particular statement. It is called fund flow statement. Fund flow statements is actually a useful tool for analyzing a financial statement that mark changes in a given point of time. So whatever the changes occurred, that changes reflects through the fund flow statements, and it reflects on the particular time. As such, there is no legal or provisions or an obligations that the published annual report that incorporate a fund flow statement. That means there is no any legality regarding the fund flow statement has to be prepared by all the organization. But the ICAI published as per Accounting 3 standard changes in financial positions, which was in 1991, and reversed in the 1997, that the cash flow statement must be disclosed by all the companies, all the public limited companies. They have to show the cash flow statement in their annual reports. Moving to the next topic, that is meaning and definition of the fund flow statement. Funds flow statement is an effort to report the flow of funds between the various assets and liabilities and the owner's capital during an accounting period. So ultimately, the funds flow statement is a reflection of the changes of fund and the comparisons of an assets and liabilities, whatever the changes are occurred between the two comparative years and outcomes derived out of it. So the statement of sources of funds and users of funds is, as its name implies, statement of the particular the source from which the funds has actually entered and comes into the business, and the uses to which they are being put. So that means the funds which are actually invested in the firm, where it is to be invested, and the funds which are actually comes in the business, from which sources it comes into the business. It is important to know that analysis of changes which have occurred in assets and liabilities between the consecutive balance sheet. It means the main object or main compulsion, main reason behind the fund flow statement is the accounting requirement is the two consecutive years balance sheet is required for making a fund flow analysis. Here the definitions, some definitions are mentioned regarding the fund flow statements. The first definition, which was given by Smith and Brown, that is, fund flow statement is prepared to indicate in summary form, that means it was a summary form, changes occurring in terms of financial positions between two different balance sheet dates. That means that whatever the changes are occurred in the particular balance sheet, it is comes through the comparison of two different balance sheet dates. One may be a last year balance sheet, and then another one is the current year balance sheet. That means the opening balance sheet and the closing balance sheet. Another definition has been given by the pattern, that is, the fund statement is an important device for bringing to light the underlying financial movements, the ebb and flow of funds. So whatever the things has been moved or changed according to the financial statements, which comes through the fund flow statement. Another definition is a statement of source and application of fund is a technical device designed to analyze the changes in the financial conditions or in a statement of a business enterprises between two dates. That means whatever the changes are occurred in financial statements between two dates, the fund flow analysis, it shows a reflection. So there are many other names of fund flow statements, which are the statement of sources and application of fund, where got, where gone statement, statements of fund supplied and applied. So these are the other names of fund flow statements identified. Now moving to the next point, that is meaning of fund and flow. The word fund has diverse meanings. Some define that the word funds as cash only. That means the fund equal to cash. So that is concern themselves with the movement in the cash account only. So whatever the changes has been occurred in the cash, it reflects into funds. That is the one meaning. As per Indian Accounting Standard 7, the word funds generally refers to cash, the cash and cash equivalent, or to working capital. So here something added to under this particular cash. It means as per the Accounting Standard 7, cash or equivalent to cash, it's considered as a fund. Not even that, the working capital is also considered as a part of fund. For the purpose of fund flow statement, the word funds means the net working capital, which is also known as net current assets. That means any changes occurred in the working capital, it also reflects into fund. So here the net current assets or working capital change, it is also reflected in the form of fund. There are also two concepts of working capital. One is a gross concept and other one is a net concept. What is a gross concept? Gross working capital refers to firm's investments in the current assets. It means whatever the investments made by the firm in the current asset, that is your gross working capital. And the net working capital, it means whatever the investments made in the current assets deducted by all the current liabilities out of it, it is called the net working capital. So this is a reflection of the gross assets and the net working capital. Now the funds mean cash only, net working capital, that is current assets less current liabilities, total resources of total funds, that means whatever the sources are there in the firm, and the total funds which concern with the total resources, internal resources also, that may be a concern a part of the ownership fund only, or reserves and surplus which are actually plowing back of profit in the business, net worth. That means the owner's equity capital plus reserves and surplus. In short, the fund means cash or cash equivalents. That is all about the fund. Here, the term flow refers to a change or transfer, and therefore the flow of funds means the transport of a monetary values from one asset to another, from one liability to another, from one asset to liability and vice versa, or a mixture of anything. So the flow of fund means comes from the one area and goes to the another structure. That is called the flow of funds. The changes in the working capital may be in the form of inflow of working capital or outflow of working capital. That means whatever the changes are occurred, it's considered directly with the inflow and outflow of a working capital. In other words, any increase or decrease in the working capital when a transaction takes place is called a flow of funds. So any increase or decrease in the working capital and changes occurred into the working capital, it shows the part of changes of flow of funds. The term fund flow designates the inflows and outflows of funds during a particular accounting period, generally a year. That means here the first idea is what? The fund flow statement has been designed and prepared on the basis of 2 consecutive years balance sheet. And the another important thing is we need to identify the inflows and outflows only in during the year. That means in the beginning of the year and at the end of the year. Between these two dates, whatever the changes are occurred, whatever the inflows and outflows are find out would be considered under the statement. The flow demonstrates the action of funds in both the directions, one inside the business and other outside the business. That means the direction has to be designed, whether it would be changed inside or an outside, it would be demonstrated. However, the flow of funds must arise due to external and not internal transactions of the organizations. That means the transactions which are occurred in the business, whatever it happens, that things to be identified through the fund flow statements. Yes, the next point is meaning of flow of fund, which actually represents the movements of funds. The movements of funds is actually comes inflow of the funds in the firm, occurred some business transactions. The transactions may be a buying of assets, purchasing of assets, maybe some amount of raw material has been purchased, then some current assets are derived, maybe the liabilities has actually occurred, and through this business transactions the flow fund is actually out of the business. So this is a process. The movement of the funds comes into the business and goes out of the business. So fund flow statement essentially studies the movement to and from the working capital area. So it is usually measured at the end of the year. So whatever the transactions we occurred, it measures at the end of the year, whether it's an inflow or an outflow. Here the inflow to the working capital for a year could be seen in terms of raise of loans, capital, sale of assets, sale of investments, and any operational inflows due to a cause of profit or loss. Funds from operations have to be adjusted. So there are many functions. Maybe funds come through the different type of ownership funds, maybe through the loans, maybe through the financial institutions helps, maybe the change of assets, purchasing and selling, sale of investments and purchasing of investments, and the change due to the operational efficiency. So in case of an operational efficiency, we need to identify that is there all the transactions are affected to the fund or a cash. If it is not affected, then we need to identify such non-cash items or non-cash items which are not directly affected to the cash or fund cannot be adjusted. So where we have to identify that. Outflows of the firm working capital include events such as purchase of fixed assets, payment of dividends, payment of taxes, payment of preference share capital, and any amount of borrowings which are going to repay at the stipulated time. These are actually an outflow of funds. So fund goes out of the business through these particular reasons. The flow of funds occurs when a transactions affects on the one hand a non-current account and on the other hand a current account and vice versa. That means if the transactions are occurred in the non-current account as well as in the current account cross, then it may be actually identified the flow of funds. When a change takes place in a non-current account, like any amount of fixed assets has been changed, long-term borrowings is changed, and if you are going to find out the changes in reserves and surplus, etc., it is followed by a changes in another non-current account, it should not necessarily be considered as the flow of funds. That means in case of if the transactions occurred in the non-current account, it's not necessary to change and identify there would be any change of flow of funds. It is because in such cases the working capital neither increase nor decrease. That means the working capital has not been changed. If it is not changed, that means the flow of funds may not be done. In the same way, when a changes in one current account results in the change in another current account, it's also not affected to the funds. In the same sense, that means if it would be changes in any case of the current account, both would not be affected to the fund flow statement. When funds move in the following transaction in certain flow of funds, then it could be identified the fund flow statement. Now here see, in case of when fund moves in the certain transactions, it causes a flow of funds also. How it would be actually affected to the flow of funds? Let's see with the standard formula or the standard understanding. In case of when liabilities increases, it's always a part of your sources of funds. But when assets increases, it's an application of funds. How it is actually affected to the liabilities and assets which would be affected to flow of funds? Let's see with the examples. Here, suppose in case of liabilities, for two consecutive years balances, one is 5 lakh rupees and the another is 7 lakh rupees. Suppose this is the last year and this is current year. Now see here, the cash balance of the last year is rupees 1 lakh. How this transaction affects to the cash balance? Let's see. Here, in case of the cash balance is 1 lakh rupees. Now how much cash is actually having in the current year? That means how much amount of the equity share capital is having in the current year? That is 7 lakh rupees. So the 7 lakh rupees would be added, the current year cash balance and current year capital added into this cash balance 7 lakh, then the total it comes to 8 lakh rupees, and whatever it was actually carried in the last year will be deducted from the cash balance, that's 5 lakh. So it comes to your closing balance for the current year. This cash balance is for the last year. Now the closing balance for the current year is rupees 3 lakh. What was the opening balance? At 1 lakh. What was your closing balance? 3 lakh. So it means it's increase. As I already mentioned, when the liability increases, it is your sources of funds. Here, this transaction reflects that the amount of cash balance is increased, and that's why it's sources of funds. Take it in another example in case of an assets.